Welcome to Uncovering Trusts, a podcast by the Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. I'm your host, Will Manuel, and today I'm joined by Chloe Wong, analyst at the Edison Group. We talk about Baillie Gifford's recent investment trust conference. So Chloe, thanks for joining us today.
Thanks for having me, Will.
Great. So the last conference Baillie Gifford held for their investment trust was 3 years ago now. What was your overall impression of the event this year?
My overall impressions of the conference was that despite the current environment of macroeconomic uncertainty and geopolitical disruptions going on around the world, Baillie Gifford's overall tone was quietly confident that they will deliver returns in the long term. They remain committed to their long term, high conviction investment style, which is grounded in patience, adaptability, and a big focus on growth companies. Across the 2 days, six important themes emerged that reflected how they are positioning for this next phase, including focusing on big winners, the role of culture, the growing strength of private markets, the opportunities in Asia, and how diversification and dividend resilience fit into their investment strategies. What came through clearly is that Baillie Gifford doesn't see volatility as something to avoid. They see it as an environment where long term thinking and differentiated ideas can thrive.
Okay, so let's now dive into some of those six themes. So let's start with the first one, the focus on a small number of big winners. Why is that such a central idea for Baillie Gifford?
So, Tom Slater, who's the portfolio manager at Scottish Mortgage, discussed his findings that only a small number of companies actually drive market gains. This conclusion was drawn by analyzing the performance of both the S&P 500 companies as well as global stocks. Both analyses reached the same conclusion that only a small number of big winners can drive portfolio success. And in the case of the S&P 500, this was 5% of stocks, which increased fivefold over 5 years. Similarly, the 5% of global stocks increased 4.5 times over the same period. This is why Scottish Mortgage backs a small number of companies that they believe will bring long-term success for their portfolio. They gave an example of this with their holdings in Nvidia, where they've been shareholders since 2016. And in the past 10 years to March 2024, Nvidia's share price has increased 80 times, and Scottish Mortgage took somewhere around £1 billion in profits in the past year. What they were trying to highlight with that was that in order to make those returns, they had to hold the stock for 9 years. This is why they believe in buying and holding for an average period of 9.7 years.
Yeah, that makes sense. So the obvious question is then, how do they find the next Nvidia?
Finding the next Nvidia is never easy, but Kirsty Gibson from the US Growth Trust believes that organizational culture is a key indicator of long-term success. She breaks it down into two types. Firstly, there's foundational culture, where the core values are set by the founder. The second is a created culture, which evolves as the company grows and adapts. And for a company to succeed over time, both need to be clearly defined and aligned. This framework is especially relevant for US growth, which can invest up to 50% of their portfolio in private companies. So the firms are still shaping their identities before going public. And when a company's culture is aligned, it helps them stay flexible and resilient, especially in volatile conditions. That's why culture is central to how they identify companies with the potential to deliver long-term returns.
Okay, that cultural insight is fascinating. You also mentioned that companies are staying private for longer. So how is Baillie Gifford approaching that trend?
So, first of all, this trend that companies are staying private for longer is extensively covered on the Edison website. And it was explored at the conference by Robert Natzler, who is the portfolio manager at Schehelian Fund. He shared that today, around 87% of US companies with over $100 million in revenues are still private, and increasingly, private secondaries, where existing shares are sold, are exceeding total IPO volumes. This means that the growing share of value creation is happening away from public markets. Schehelian exists to bridge that gap. It gives Baillie Gifford clients exposure to later stage private companies that are scaling fast but not yet public. Often it's in areas like biotech, fintech, AI. And these companies typically have strong growth margins, clear unit economics, and a robust cash position. In fact, it was shared that nearly 70% of Schehelian's portfolio had more than 4 years of cash runway, which provides resilience.
Yeah, no, that's some impressive data. So let's talk about portfolio construction now. How are Baillie Gifford's trusts building resilience into their portfolios?
Another key takeaway was that the importance of resilience as a proactive way to thrive through volatility. For instance, the Monk's Trust builds resilience by having a diversified three-dimensional growth structure. These included growth stalwarts, which are long-term compounders. There are rapid growth companies and cyclical growth companies. This blend of different types of growth companies allows them to ride different waves of market behavior. I found this to be practical, especially in a world where not all tech is booming. Whereas the Baillie Gifford European Growth Trust offered a different take on resilience. Their team focused on aligning company fundamentals with market expectations. In other words, it's not just about whether a company is growing, it's about whether it's growing more than people think.
Yeah, I think that's right. And so geographically, you mentioned that Asia was another focus. What are Baillie Gifford's views on the long-term opportunity in the markets there?
Yes, emerging Asia and Japan were a key focus. Roderick Snell from Pacific Horizon Trust talked about how Asia is a major long term growth opportunity, with over 80% of the world's new middle class consumers coming from that region or will come from that region. And markets like Vietnam and China are already showing domestic strength and getting policy support for growth. The China Growth Trust made a strong case for contrarian optimism. Chinese companies are currently trading at a 50% discount to US peers, even though their earning growth is just as strong, and if not stronger. And in areas like AI, development is happening at a third of a cost compared to the US. Japan is also getting renewed attention. It's long been seen as a stagnant market, but according to Matthew Brett from the Japan Trust and Brian Lum from Shinnippon, that view is shifting. After 30 years of their economic slumber, Japan is showing signs of reawakening. Companies are getting pricing power, they're becoming financially fitter, which could improve valuations. On top of that, we also see real wage growth, infrastructure investments, and low inflation, which creates a better environment for selective growth investing. The Japan Trust is focused on companies riding this domestic momentum and expanding globally. They see Japan not as a recovery play, but as a rare growth opportunity in a developed market. Whereas Shin Nippon targets Japanese small cap companies, which is part of a market with 3,000 to 4,000 listed companies. And many of them are founder led and operating in a niche or emerging sector that doesn't get much analyst coverage.
Right, interesting. So, um, finally, what's the role of income-focused strategies within this long-term growth framework? And did the Scottish American Investment Trust, which I think is also known as Saints, stand out again this year?
Yeah, so For more conservative or income-oriented investors, things does stand out. James Dow reminded us that resilient dividend growth is what delivers long-term income security. During the COVID shock in 2020, 9 out of their top 10 holdings increased their dividends. And that wasn't just luck. That was the result of a carefully curated portfolio. They use a resilience checklist to filter out which companies have high debt, fragile margins, or unsustainable payouts. The result is then their portfolio yielding at 3%, and that's comprised of companies that combine long-term earnings compounding with dependable income, and they target around 10% annual growth.
Great, thanks, Chloe. So that's a really good overview of the key messages coming out of the conference. So if you had to sum it up, what's the one takeaway for investors from Baillie Gifford's positioning right now?
I'd say that the core message is that Baillie Gifford is standing firm in its belief that long-term growth-led investing will continue to deliver over time. While others may panic in short-term uncertainty, they're clearly staying the course and looking ahead.
Okay, so thanks again, Chloe. Thanks to our listeners for joining us on Uncovering Trusts. If you'd like to read more about any of the trusts mentioned in this episode, head over to Edison's website at www.edisongroup.com.